Welcome to the Wealth Spot. Today we will talk about the real estate market and its possible scenarios. Hit the like to help us, and let's get started. The price of real estate seemed to be on a perpetual rise since the 2008 financial crisis, driven by low interest rates. However, the landscape changed dramatically, starting in 2022, when central banks initiated the most significant monetary tightening cycle in the last 40 years. Consequently, real estate asset sales plummeted in affluent countries worldwide. Investors are now questioning whether the worst is over, as most central banks have already raised interest rates. For instance, the Federal Reserve, Fed, increased the U.S. benchmark interest rates to a range of 5.25% to 5.5%, the highest level in 22 years. Renowned investors like Warren Buffett and his trusted partner Charlie Munger have sounded alarms about an impending storm in the real estate sector. This storm has already begun to show its initial effects, with slowing sales, rising defaults, and property devaluation. According to Buffett, this is just the beginning of the consequences that will be felt in the United States. However, Buffett and Munger are among the less pessimistic voices. They suggest that the real impact will manifest in the coming months, as many banks hold a considerable number of near-default loans, which will become riskier as property prices drop more significantly. Nevertheless, they emphasize that the situation is far from being as severe as it was in 2008. On the contrary, another group of analysts sees this optimism as misplaced, given that the measures may take some time to effectively impact the real estate market. Since the 2008 subprime mortgage crisis, regulators have steered lending toward shorter terms to mitigate the risk of bankruptcy or a financial system collapse. However, at the onset of the pandemic, governments injected money and lowered interest rates, resulting in more people financing homes at variable rates, contributing to another price surge in the sector. In any case, with higher interest rates, the trend continues to be a decline in property prices, especially in wealthier countries. To grasp the gravity of this effect, according to the Royal Bank of Canada, today, the typical Canadian homebuyer spends almost 70% of their household income on mortgage payments, property taxes, and utilities. In 2020, the figure was 46%. Still, when asked, most people intend to buy their own home. Are you part of the pessimistic camp or the optimistic one? Share your expectations for the real estate market in the comments. Consider subscribing for more content like this. Until the next video, bye.